When the Fed cuts interest rates, the US dollar usually becomes weaker. This is very important to understand. Think about daily shopping. If your money becomes weaker, you need more money to buy the same product. Gold and silver are priced in US dollars. So when the dollar becomes weaker, it takes more dollars to buy the same amount of gold or silver. Because of this, gold and silver prices go up automatically. There is another side to this. For people outside the United States, a weaker dollar means gold and silver become cheaper in their local currency. This encourages more buyers from other countries. More buyers mean more demand, and more demand pushes prices higher. Now, let's talk about inflation. In the simplest way, when interest rates are low, borrowing becomes easy. People take more loans to buy houses, cars, and other things. Businesses borrow money to expand and grow. All of this puts more money into the economy. When there is too much money chasing the same goods, prices go up. This is inflation. We see this in daily life. Food becomes expensive. Rent goes up. Fuel costs more. Everything slowly becomes costly. When people see prices rising, they worry. They worry that their savings will lose value. They worry that the money they worked hard for will not buy the same things in the future. So they look for something that can protect their money. Gold and silver have done this job for hundreds of years. They hold value better than paper money. That is why people trust them during times of inflation. Sometimes gold and silver prices rise, not because inflation is already high, but because people expect inflation to rise in the future. Now, let's talk about fear and uncertainty. When the Fed cuts interest rates, it can be seen that the economy is slowing down. And when people feel unsure about the economy, they become careful. Think about your own life. When you feel uncertain about your job or income, you avoid risky decisions. You try to protect what you already have. Investors behave the same way. They move money away from risky assets like stocks and put it into safer places. Gold is seen as one of the safest assets. Silver also benefits because it is both an investment and an industrial metal. So when uncertainty increases, demand for gold and silver rises. Now let's talk about cheap money. Lower interest rates mean loans become cheaper. Big investors and companies can borrow money at low cost. They use this money to invest in different markets. Some of this borrowed money goes into gold and silver. This extra money increases demand and pushes prices higher. Think of it like a discount sale. When prices are low, more people buy. When more people buy, prices move up. Now let's look at the long-term view. Gold and silver are not just investments. They are also seen as stores of value. When people lose trust in paper money, they move toward real assets. Rate cuts often increase money printing. And when people see more money being printed, they worry about the future value of currency. This fear pushes more people toward gold and silver. So let's slowly wrap this up. When the Fed cuts interest rates, savings give less return. The US dollar becomes weaker. Borrowing becomes cheap. More money enters the economy. Inflation fears increase. People feel uncertain about the future. All these things push people toward gold and silver. That is why gold and silver prices usually rise after a Fed rate cut. It is not magic. It is simple human behavior. If this explanation helped you understand why gold and silver move the way they do, like the video, subscribe for more simple money explanations, and comment below. Do you prefer gold or silver as a safer investment? See you next time.